Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And in today's video, we're going to cover the data that came out this week. If you remember, last week we covered the inflation data and the employment data, and we really were focused on whether the Fed would raise interest rates or not at this coming meeting. It looks like from a market's perspective, that's where they're headed. Markets are pricing in that extra increase here next week. But how does this data coming out this week shape that opinion? We've been talking about how the data has been improving, although I think I've been using the word kind of the sideways action or the sideways consolidation. I think that call still makes a lot of sense, particularly when you look at the data that was released this week, because what we have been seeing, at least in the data coming out from manufacturing and housing that was posted this week, we started to see that improvement slow down. We're going to highlight that by looking at the New York and Philadelphia Fed manufacturing survey data, by the industrial production data, by the retail sales, and then follow all of that up with housing, as well as maybe taking a look at the market and why the market may be hitting some resistance here as some of this data continues to slow down here. And so that's really the title of our video today, is that the improvements are beginning to slow. And I want to show you that here by looking at the data that's coming out this week. That has came out this week. So let me get started. Let me show you some charts. I'm going to show you a little different viewpoint than what we've been doing. Before, I had all of our charts opened in different panes. Now I just have one chart deck. Hopefully that will consolidate it and maybe make this more visually appealing. And again, for those of you that are subscribed to our research, you'll get these charts with our weekly review, as well as getting this weekly review earlier than those that don't. So we started the week with the New York Fed manufacturing survey data. That came in better than expected from the perspective of, hey, it looks like it's been improving, and you can definitely see it from the chart perspective. But from a prior month, it decelerated. It decelerated from 6.6 down to 1.1. That wasn't the only thing that we saw. We saw employment pick up, and we saw prices paid coming down. So even though the general business activity declined, we did see the employment and prices paid continue to improve. So it's like a good sign, bad sign here for this New York survey data. What I also thought was really interesting was future business optimism declined. So even though it looks like from a chart perspective that it might be bottoming and trying to hook a little bit higher here. Like, let me grab this here, and you can see kind of this U shape taking hold here. Even though you're seeing this, future expectations declined 4.6 points to 14.3. But it wasn't just New York that kind of saw this decline in activity. We also saw it in Philadelphia. So Philadelphia came in right with where it was in the prior month. So the prior month was minus 13.7 points. It came in at minus 13.5. But that really wasn't the surprise in the report. The surprise in the report was the June reading on new orders. And you can see it here, how the new orders declined a little bit here on a month-over-month perspective. The May reading was at minus 11 points, where the June reading was minus 15.9. So you can definitely see that the new orders continued to be sluggish. The other thing that we saw was employment remained slumped, and you had prices kind of moving sideways, so they stopped deteriorating there. We do need Texas to kind of consolidate this for us. Of course, you're also going to get Texas and Richmond next week, along with the GDP report. But it definitely, to me, looks like there is this momentary pause in the bottoming that's been taking place in manufacturing. Now, that pause, I think, got cold water thrown on it when we got the industrial production report, though. So even though New York and Philadelphia clearly showed like this bottoming process taking place, industrial production continues to slow down. So the prior month industrial production report was minus 0.2% month over month, where the current report came in at minus 0.5% month over month. And you can see directionally how it has peaked and it has begun to roll over. And even this most recent rise, which is what we were talking about, improvement of the data in manufacturing, gave way to this decline that you're seeing here. Now, it wasn't a whole report decline. Most of the decline was in this durable goods, from durable consumer goods. That was down 2.7% in the month, and primarily reflected utilities and motor vehicles. I've got motor vehicles and parts here with you, and you can see briefly here how there's this topping pattern taking place. It looks a little better on the cycle perspective as well. In particular, we started to see those index drop 3.6% on the motor vehicle and parts, and the utilities came down 2.6%. You can barely see it on the general level, but you can see it really well on the cycle, how that's come down quite a bit. So to me, this manufacturing data, we've been talking about how we need other sectors of the economy to kind of carry the weight for this recovery to take hold. Remember, the service side of the economy is the only side that's really showing any signs of strength here. Manufacturing still looks to be stalling. So the improvement that we saw in the last couple months has kind of hit a wall here and has kind of receded back down. We're going to talk about housing in just a second. That's another component that we need to continue to improve. And then finally, financials, we need those to continue to improve. And we looked at that last week a little bit here. Let's come down a little bit further. The other thing that we got was retail sales data. So the retail sales data actually came in at 0.2%, but there was a little note in there that I think may have gone missed if you didn't actually read the report. The U.S. Census Bureau actually came out and said there is insufficient statistical evidence to distinguish between the actual change being different from zero. So to me, there's going to be a heavy revision to this retail sales data, and maybe we shouldn't put a lot of weight or a lot of stock into it. What I did notice, however, if you do end up picking through the report and looking at the report, despite that claim from the Census Bureau, you can definitely continue to see a flatlining in retail sales. So it doesn't look like there's been much change at all for several months. In fact, it looks like it's now decelerating relative to trend. And this is just more economic data that is slowing on a cyclical perspective relative than a level perspective. One of the things that we saw, and I just mentioned services being very strong, inside of there's really only one component that gives us an indication to services, and that's the food service and drinking places. So that's restaurants and bars. You can definitely see how it's been strong on this uptrend here, but you can see that it weakened just slightly here, and it is slightly below trend. About 1.3 million below trend. And so I wanted to point that out. I think that's really interesting that we kind of saw this peak several months ago, this stalling, and then now we're starting to see that roll back over again. It's back to the levels that we saw shortly after the recovery in 2021, shortly after the initial decline of maybe Russia invading Ukraine, everyone being a little bit worried about inflation taking off and interest rates taking off. But I think broadly speaking, it's still consolidating sideways, which has been our call here. That's just, again, one indication from services from the retail sales data. You know, that statistical insignificance or insufficient evidence tells me that maybe we shouldn't put a lot of stock in this report. So we're going to kind of skip over it for now in this report. That brings us to some more data that came out, which was housing. Housing, if you remember, we were saying housing was bottoming, and it definitely looked like we were getting a recovery in building permits and housing starts. That stalled in this most recent report. Building permits came at 1.44 million versus the prior month at 1.496 million. So permits, let me see if I can get this right. Permits were down 3.7%. Housing starts came in at 1.434 million compared to the prior month at 1.631 million. That also was down 8% in 8% from the May reading. What I did see interesting, although both of these came down and showed a slowing of new activity for construction in the future, because remember, you've got to have a permit and you got to have a start before you have a new home built. With both of those slowing down, that means future activity or future new homes are going to be off the market here. I did see a rotation. So again, we've been talking about the multifamily units picking up the primary load here for building permits and housing starts. And you can still see this trend generally unfolding of single family starts accelerating higher from here. So here's single family, Here's multifamily. You can see how multifamily is kind of rolling over on the housing starts. Here's completions. Completions still look really good. So everything in the pipeline is still getting done. Here's those permits, again, kind of flatlining or stalling here. And then coming down to single family permits, those look really good, accelerating back above trend, where the multifamily decelerating pretty dramatically here. So it's definitely a situation where we are seeing more people move into the single family area from a construction perspective. That makes a lot of sense. I'm seeing incentives from home builders that are providing better interest rates relative to banks. So that's something that we need to take note of, that maybe there would be some more additional activity happening in that space. But definitely this is a complete different comparison, seeing an 8% decline in starts and a 4% decline in permits. That's completely different than the bottoming that we were seeing beforehand. So again, I'm not necessarily saying that the improvement or the recovery is leaving us. I'm just saying that the improvement is slowing down, and we need to be cognizant of that. One of the reasons why we need to be cognizant of it is because monetary policy lags are very long and variable, and we know that. One of the reasons why we know that is many economists have been studying it. Some people think that it's as short as 12 months, and some people think it's as long as 15 quarters. There's a famous economist, Alan Oster, who wrote the book on lags and monetary policy. And he said that monetary policy lags were uncertain to measure because during those shocks that actually make you implement monetary policy, there's usually financial deregulation and financial innovation to help get you out of that shock. The timing and the stage of the cycle when that shock takes place actually plays a portion in this as well. And then the extent to which policy is anticipated from market participants is another reason why we can't measure policy lags with any certainty. And so that, in a nutshell, is why we may not be out of the woods just yet from a policy lag perspective. One way that you can see it here is coming down to existing home sales. We know the Fed's been raising interest rates rapidly, and by raising interest rates, we know it hits the interest rate side of the economy first, and we started to see home sales deteriorate again. So in fact, existing home sales for this particular month came in at 4.16 million versus the prior at 4.3 million. That decline is roughly, let me pull my notes here again, I'm sorry, is a 3.2% decline. What we are seeing is probably what you're seeing in your local area. The inventory and the month's supply of homes on the market is still extremely low. What that's doing is it's keeping prices elevated, that what you're seeing over here in the median price. And that's creating a situation where the affordability is still out of reach because the interest rate is high and the price is high. The National Association of Realtors chief economist, Lawrence Yun, I'm going to read a comment from him. It's a couple paragraphs, so give me just a second here. Yun says that the first half of the year was a downer, with sales lower by 23%. Fewer Americans were on the move despite the usual life-changing circumstances. He does believe that the pent-up demand will be realized soon, especially if mortgage rates and inventory move favorably. Right now, they're not moving favorably as interest rates are backing up higher, anticipating 2 more rate hikes. And again, you're seeing inventory here stall at relatively low levels here. He goes on to say, however, there are simply not enough homes for sale. The market can easily absorb a doubling of inventory. Home sales fell, but home prices have held firm in the most part of the country. The national median home price in June was slightly less than the record high that we saw nearly a year ago at $414,000. Limited supply is still leading to multiple offer situations, with almost a third of homes getting sold above the listing price in the month of May. So I do think visually this continues to highlight the long and variable lags of policy. And it's one thing that market participants and even economists are uncertain about. We just went through an environment where the Fed has raised interest rates 5%. They're going to potentially raise it another 1/4%. And by doing that, we're uncertain of how those lags are impacting sides of the economy. We can see visual signs that the housing market's in recession. We can see visual signs that manufacturing is struggling. We're not seeing visual signs that the service side of the economy is experiencing these lags. We're seeing signs that inflation's coming down. So that's another sign that the lags of policy have been taking effect. But I'm looking at this and saying, hey, let's not sleep on them, right? If we can think about it intuitively, this is where my sideways consolidation call in both the market and the economy makes a ton of sense. If they're going to continue to restrict monetary policy, if fiscal policy remains on the back burner because we now have a spending cap between now and 2025, then it likely means that we move back into like a fundamental type environment where it's going to come down to how resilient the consumer is. As we're going to get next week, we're going to get the GDP report, and it should be favorable in nature because we saw the second quarter come in pretty strong. In fact, when you look at the coincidence economic indicators, which are things like incomes, consumption, production, and employment, it should show somewhere in the market of a year-over-year percent increase of between 1.7 and 1.9% year-over-year. We'll see how close that comes, but really, I think we're still probably seeing the early signs of policy taking hold here, with little support coming from the fiscal side. And then that basically means that the consumer is going to have to remain resilient and strong going through the remainder of this year. To me, it points to a picture of a very sluggish economy continuing to take shape here, an economy that will continue to grow below trend. One other measure that we can think about that we must continue to put on the forefronts of our mind is the student loan forgiveness program. Those payments now for many of Americans are going to be turning back on. And because the average payment is roughly $300 per month, you imagine that's going to take a big bite out of the service side of the economy for those of us that are carrying student loans. Now, remember, it's not just millennials. There are our Parent Plus loans in the data as well. So it could hit multiple different generations right when the economy needs the consumer to stay healthy and resilient. They may have to divert funds to their student loan turning back on again. We'll see how that shakes out, but what we can say for certain here is that the improvements that we've seen over the last several months have started to stall here, as evidence from housing starts, building permits, industrial production, and some of those manufacturing reports. Now, what does that mean for investors, and what does that mean for the stock market? Well, to me, it seems like we can't sleep on these policy lags, that they may still be having some impact on the economic data, and they may still be having some impacts on the financial markets. Particularly, what we haven't seen yet is company earnings and restructuring of company debt. That will happen as the cycle goes on. And if interest rates remain at high levels, any company that's going to have to restructure debt coming due or short-term debt rolling over will likely have to renew those rates at a much higher rate. And we know that at the same time, if the economy is sluggish and growing at a very, very slow pace, it's likely that corporate profits will remain sluggish or grow at a slow pace. And because of that, I would expect company earnings to remain somewhat muted. The market's now only pricing off of earnings. You can see down here that investors have gotten very bullish here of late. The AAII bullish bearish sentiment is up to almost 52% right now. And you can definitely see it in the price action where it sets at 4,536, well above the 50-day, 100-day, and 200-day. And on top of that, you've started to see some broadening out as real estate, financials, and materials and industrial start to return some positive, where you've got technology, communications, and consumer discretionary still at a very extreme level here. So, I'm looking at this and saying, okay, policy lags look to be still having some impact on the economic data. 1 month's data is not enough for us to anchor on. Let's get a little bit more to see if that's going to be the case here. But it seems like investors are pricing in optimism and pricing in a lot of the forward earnings that's expected over the next calendar year. And so I'm looking at this and saying, okay, policy lags, we don't know how long those are going to take shape or how long they're going to take hold of the economy. But to me, it seems like my initial call of a sideways market could continue to play out here as I continue to forecast a sideways economy here. To me, I think the economy and the market go hand in glove. The market does try to front run the economy, but if these policy lags have yet to take hold, if the Fed's not done with their restrictive monetary policy, in fact, they've talked about continuing to roll the balance sheet off in the background, and they've talked about raising interest rates 2 more times. If those continue to take shape and if those continue to take hold, then I would have to assume that the market is going to trend sideways unless company earnings just come in dramatically better than what everyone's expecting. As of July the 14th, only 6% had reported earnings. Only 6%, I'm sorry, of companies earnings, 60% reported positive earnings, and 80% of those 6% have reported positive revenues. So far, they're coming in better than expected. We're going to need all of them to come in better than expected, in my opinion, to meet realize the high lofty expectations that investors have now. We'll put a cap on this run up that we're experiencing. Company earnings. So with that, I think this is a great place for us to stop. I hope that today's information was helpful for you. Next week, there's going to be a lot of really good pieces of information, particularly around the Richmond Fed survey, Texas, Dallas Fed survey data, as well as the GDP report for the second quarter. We're going to get durable goods orders as well. We're also going to get the Case-Shiller home price index, which also should echo what we're already seeing in existing home sale data. And then finally, we're going to get new home sale data as well. So with that, just if there's anything at all that we can help you with, don't hesitate to leave us a comment below or shoot us an email. We're happy to answer those for you. If you like these videos, subscribe and like. That'll help YouTube continue to recommend our content to others who might find this valuable. And we'll be back again next week with another update.